Okay, we're going to start from audit risk assessment, and we talked about the three types of audit risks. We have inherent risk, controller risk, and detection risk, and we defined all of them. So I will not go over that again. Then we talked about materiality, and we said a matter is material only if its omission or misstatement will affect the decision of the users. I think that one is very clear. Then we talked about the stages where you check materiality. It is at the planning stage, during the audit or after audit, or during the audit conclusion. And the point I insisted on is that when you're checking materiality during audit conclusion, that one will affect the opinion of the auditor. Then we have the criteria for judging materiality. That is where we were supposed to start. And one of the criteria is value criteria. And this is whereby you judge materiality on the basis of amount or quantity of the item. And you have a table there. So you can use an example of item X. So we're checking whether an item is material. So is a certain error material. So if you're going to check it against profit before tax, you check, is it more than 5%? So if it is more than 5% of the profit before tax, that item is material. Then you can also use profit after tax. That one, the value changes, it's 0.5 to 1%. Then you'll be able to make a judgment based on the value. So that item, you check it against profit before tax. Is it more than 5%? Then it is material. Then the second criteria is impact criteria. And this is whereby an item has the aspect of converting a profit into a loss or a loss into a profit. So if, for example, our profit before tax is let me just use 500,000. And then in directors bonuses, we have an error. We wrote it as 700,000. So if at all we were in profit and then we bring this aspect of director's bonus, it will take this profit into a loss. Then that one is a material item based on impact, the impact it has on the other items of the balance statement. Then we have nature criteria, that some items are considered material by the virtue of their characteristics, regardless of the amount involved. Then we can also compare the magnitude of the item with the overall view given by the accounts. We can consider the cumulative effect of a misstatement. So when we're talking about cumulative view is, so we have misstated this director's bonus. What will be its cumulative effect on maybe the income statement? Will it flow over to the balance sheet? Things like that. Then considering whether there are any statutory considerations. So that is how you judge materiality. And then you have a distinction between planning and performance materiality. So we have analytical review procedures. And I told you that analytical review procedures are also very important when it comes to auditing, because this is whereby, and they are the procedures that are done when you're auditing. You cross-check, you do some summation, you do some sampling, so, and they are done at the planning stage. So one of the ways to do them, or one of the reasons for doing them, is to assess the risk, to identify potentially problematic areas, to determine the amount of time that will be required in the audit, to determine the staffing requirements, and to determine the nature, extent, and timing of further risk assessments. So when you're doing an analytical review procedure, they're just procedures. Analytical means weighing. You're just weighing, you're checking against something else to be able to know how much staff do we need, how many people do we need, how much time will we use in the audit. That is all about analytical review procedures. Then we also have developing the overall audit plan and strategy. And a strategy is whereby you seek to set out the scope, timing, and direction of the audit. Scope is the extent, timing is just the time that you will use, and direction is the direction that the audit will take. And when you're doing an audit strategy, there are matters that you're supposed to consider. One is the characteristics of the engagement. So there are various types of engagements. We've already talked about it. And you're supposed to consider what kind of engagement is this? Is the owner trying to sell the business? Do they just want a valuation? Is it a statutory audit at the end of the financial year? Those are things that you need to consider. Then there are some significant factors, like even the political environment and things like that. Then the determination of materiality, that one we have already belabored on it. The preliminary risk assessment, impact of the assessed risk, reporting objectives, and volume of transactions. So those are the matters that you may consider in establishing the overall audit strategy. I hope that one is very, very clear. If there is any question, you can always reach out and confirm. Then for audit strategies and approaches that are listed there in our handout, that one we have already covered before. In our previous handout, which we were using, it wasn't arranged like this, but we have already covered audit strategies. So if you have forgotten, just go over them again. And in case of any question, we will go over them, no worries. Then we now go to preparation of working papers. So in preparation of working papers, so we start by defining audit documentation, and it is the record of all audit procedures performed, relevant audit evidence obtained, and the conclusion reached by the auditor in the working papers. So there are some three things that we are considering that are very, very important. One is procedures performed. The evidence obtained. And finally, after doing all these, then the conclusions reached. So those three are audit documentation is just putting these three in writing. So examples of audit of working papers will be like audit programs. Audit programs is just normally, as you know, a program. So we will start with getting to the company. We will obtain the financial statements. How will you do the audit work? Then we have analysis, issues, memorandum, correspondences, communication that you have been made between the client and the auditor, internal memos within the audit staff, things like that. Then you have checklists, letter of representation, and letter of internal weakness. So those are examples of working papers. Basically, working papers is documents zenye umetumia during the audit. Anything, communications you have made, programs, things like that. Hizo ndizo tumelist hapo. Then you have some qualities of good working papers. That one I will not go over them. I think that one is like, hizo ni vitu rahisi. So just read qualities of good working papers. They are there in the handout. Then you talk about importance of documentation. So one thing to note about any kind of documentation is that it provides proof or evidence that the audit was planned out and carried out in accordance with ISA. So procedures. So the ISA has guidelines on how you are supposed to perform procedures, such as the analytical review procedures. If you document them, then that one will act as evidence that when you are doing those procedures, you followed the guidelines that are stipulated by the ISA. Then it will provide a basis of the auditor's conclusion. So these two that are part of the working papers will act on as the basis for the conclusion that has been reached. Then they provide direction and supervision to audit staff. So basically, this one we're talking about the audit program. The audit program, which is an example of a working paper, will provide direction and supervision to the audit staff. Then they facilitate quality control review. After you're done with an audit, a quality control review is supposed to be done, maybe by another partner or by another audit firm. And how they will be able to do the quality control review is by checking your working papers, going over your working papers. And then they facilitate control of the current year's work. That one is, I think, is clear. They can be used for training and they provide up-to-date findings. Then you have how you organize working papers. So you can have a permanent audit file and you can have a current audit file. Those are the two types. So a permanent audit file, these are information that is recurring in nature. So we know that you can have an auditor for maybe even 3 or 4 consecutive years. So when you have that, there are some things that they don't change, like your memorandum of association, articles of association. Those ones were made when the business was being incepted and they don't change. So your auditor, if it is a recurring auditor, he will just have those ones in a permanent file. You see that are changing. Then we have relevant legislations, copies of documents, list of lawyers, physical address. So those are things that are put in the permanent audit file. So remember that these are items that go beyond the year of the audit. They do not change on an yearly basis. Then we have current audit file. So these ones are the ones that change on a daily or on a yearly basis, like the financial statements. So financial statement, when it comes to working papers, will be in the current audit file. Then audit plan and programmers and or programs, that one will also change because we will make a new one each year. Then internal questionnaires, questions that we ask the staff when we were doing the audit, that one will also change on an yearly basis. Then a copy of management letter, you have to write a letter to management every year. Then a letter of representation, also that one changes every year. So I hope that one is very, very clear. Then there are some factors that affect the form, content, and extent of audit documentation. So one is the nature of audit engagement. So if at all this is my first engagement with the client, so now we're talking about nature, then I will not have a permanent audit file and a current audit file. I'll just have one audit file. Because then even things like memorandum, things like articles of association, they are things I'm getting for the first time. But if at all this is a continuing audit engagement, then there are some things that they provided me with at the start of the audit engagement, and I don't really need a repetition. I don't need that information again. Then size and complexity of the audit, also that one will determine how much you write. If it is a big audit firm, then things like correspondences, programs, they'll be very large compared to if it is a small firm. Then identified risks. If an audit is very risky, you will want to document everything to prevent people saying that you are negligent. So procedures performed, evidence obtained, you'll want to document them very well. So that is how identified risk will affect the form of audit documentation. Then we have audit methodology used, significance of audit evidence obtained, and nature and conditions of the client's ICS and accounting system. Then you have limitation of gathering working papers. So we have some limitations that make establishment or making of working papers difficult. Some of them will be lack of cooperation from the client staff. So even we said internal questionnaires, they are also part of your working papers. So if at all the staff are not giving you information, then establishing or having such working papers will be very difficult. Then technicality of the client business. If you don't understand the client business, then procedures performed will be very shallow, and that one will affect your working papers. Then incomplete records. If you have incomplete financial statements, then you won't be able to obtain enough evidence. Then weaknesses in the internal control systems, time consuming, and lack of cooperation from third parties. I think that one is self-explanatory. Then We have classification of working papers. We have standardized and unstandardized. So standardized just means you're using a template. There's a standard and you're using that one. Unstandardized means you're making it from scratch. Then automated versus manual. Automated means your working papers are in the computer. Manual, you're just writing them on paper. Then you have some challenges of and benefits of automation. I'll also leave you to read that one. In case there is any question, you can always ask me, but I think there are easy points that are easy to remember. Then there's a question that arises on who owns the working papers. So working papers, the auditor has come to the client firm, has asked people questions and has obtained internal questionnaires. He has done some procedures using, let's say I am the client, he has used my financial statements and done analytical review procedures, and he has obtained evidence. So who owns those working papers? Do they belong to the auditor or do they belong to me? I may argue as the client that I'm the one who has given you work as the auditor, so the audit papers or the working papers belong to me. But the auditor will argue that he's contracted, he's not an employee, so they belong to him. That is a major question that arises. So on the custody and ownership of the working papers, there's some general principles that try to prevent that kind of push and pull. And one of the principles is that documents belonging to the client must be given to the client promptly on request. So if at all I have given you my financial statements, in this case, I am taking the role of the client. If I've given you, the auditor, my financial statements, they should be given back to me promptly on request. Then for documents belonging to you as the auditor, if I want to inspect your documents, you as the auditor, it is upon you to decide whether you will let me inspect them. And then where I as the client request that you disclose my documents to a third party, you're supposed to do that. And then where they are your documents, you're not obliged to comply with my request to reveal that one to third parties. I hope that one is very clear. I have used that example so that those 4 points become very clear. So there was a case there, you will go over it, what the client was claiming, what the auditor was claiming, and finally it was held that the auditor, the working papers are bona fide, or in a case of absolute good faith, they belong to the auditor since he is not an agent of the client, but an independent contractor. So an auditor is not an agent of the company. That's why they are supposed to be independent. They're supposed to be like, there's some rules that govern auditing. So an auditor is an independent contractor. So I think that is that on audit working papers. I don't think there is much about that. Then I'll talk a little bit about audit quality control. And so I said these are procedures that are adopted by the firm to provide reasonable assurance that all audits done by a firm are carried out in accordance with ISQC. So these are procedures after the audit. An audit firm is required to do audit quality control procedures. So they can do them at the audit level or at the individual audit level. So this is where, but for most auditors, you will go over the notes, but mostly what we are trying to do is just to show that this firm, you are the auditor. In this case, I am the client. So after you, the auditor, has done the audit engagement, then you will require maybe another partner in the firm to go over your working papers, and then they'll be able to give a view on whether they feel you as the second partner did a quality job with the audit. So that's what we call audit quality control. So they just ensure that the audit work was of high quality in accordance with ISQC. So just remember that. Very, very easy. So the reason why we do audit quality controls is to prevent some things. Some of the things that we are trying to prevent is the risk of an auditor giving an inappropriate opinion. That is always a risk. In audit risk, that is one of the major risks, that an auditor will give an inappropriate opinion. So if we have done an audit quality control procedure, we'll be able to at least know that the auditor will give an appropriate opinion. Then there's the risk of damages, risk of being sued for the sake of giving an inappropriate opinion. Then the risk of losing the client and future prospective clients. So if I am the client and then I see, oh, you guys did a good job with your working papers, and then after like 2 weeks, I get another report on quality control by a second partner in that firm, then I have a lot of confidence in you as the auditors. Then risk of adverse publicity. If at all, we said that an auditor needs to look good even to the public. So if at all I know that an audit firm is doing quality control procedures, it will be very good publicity for you as the auditor, and then saving your practicing certificate, of course, by doing quality work. So I think that is the most important thing. You will go over some of those quality controls. Something else I need to talk about is reviews. There is a difference between a regular review and an independent review. So in terms of quality control reviews, we have several types. We have hot review, post-audit review, second partner review, and peer review. They are all types of quality control reviews. Now you remember, I don't want to repeat that again, but remember why we are doing quality control reviews. So a hot review is the regular review that takes place as the audit is progressing. So you as the auditor, let's say you are a senior person in the audit firm, when your juniors check, maybe you've given someone to check profit before tax. After they are done, you tell them, send it first to me or to you as the senior auditor. So that one is a hot review. As the audit is continuing, you're doing a quality control, checking, are your juniors doing a good job? Then you have post-audit review. Post-audit review is done at the end. After you've done the audit, then it's done at the end before it is written and signed. Then you have a peer review. Peer review is where it is done by a peer. So another auditor checks. Could be an auditor in your firm, could be another audit firm. That is what we call external peer review, where you get another audit firm to check your work. Then we have what else? Second partner review. So second partner review is where another partner checks your work. I'd already alluded to that. So I think that one should be clear. In case it is not, you just ask. Now, I promise we will not go over internal control systems, but because of time, we need to do also internal control systems before time. So on internal control systems, so these are a system of controls that prevent frauds and errors, and they are put in place by management. So some of the things that internal control procedures do is to check that a business is conducted in an orderly and efficient manner. That is one. That assets of the organization are safeguarded. that there is adherence to management policies and to secure as far as possible completeness and accuracy of financial information. So internal control procedures, they're the small things that you do in an organization to ensure that you safeguard maybe your assets, you ensure that business is orderly and efficient. So there's an example I used and I will use it again just to belabor that point. If you have a customer comes into KCE, you as the customer, you come in, you talk to someone, you ask them how much is charged per unit or per section, then you pay. So they tell you, you pay via the till number. Payment via till number is an internal control system, because then if I talk to the client, sends money to me, sends money to this one, then we are losing point number one, where we ensure that business is conducted in an orderly and efficient manner. Then also, in the midst of all that, someone might just go with the money sent to them by the client. So that one, we will lose assets of the organization. Then maybe we say after that, we have a rule that even physical students should have the app so they can be able to watch some videos. They might help them. So that one is adherence to management policies. So we have those internal controls. They help management in running business. So we have elements of an internal control system. One is control environment. Two is control activities. Three is risk assessment and management. Four is information systems and communication. And the fifth one is monitoring. So we will start with control environment. And control environment, it refers to the overall attitude, awareness, and action from management regarding the ICS and its importance to the entity. So how do management view internal control systems? Do they feel they are important for the organization, or do they just take them lightly? Then we have some control activities. These are the policies and procedures which management has established to ensure that nothing goes wrong. So control activities, they are things that are done to ensure that things are right. For example, you can say, let me check a good example that will help you understand. So if it is like, let me use an M-Pesa shop, So you can have, you are the owner of an M-Pesa shop. As an internal control procedure, you can have that at the end of the day, and most of them do this, at the end of the day, you have to reconcile your float versus the cash versus whatever your books are saying about the money that you've given out. So that is a control activity. It's a thing that you do. Then you have another example is restricting physical access to assets and records. So another activity that you can do is hiding your title deed to your land, to the land of the organization. That is also an activity. So I hope that one is clear on the control activities. Then we have risk assessment and management. So this is, as your internal control systems should be able to identify the risky areas in your business. So if we have maybe employees are many and you feel like most of them are talking to clients, you can limit the number of people that talk to clients. So you say only A, B, and C are allowed to talk to clients about marketing. Then that and that, because your internal controls have established a risk area. Then you have monitoring. So this is the process of establishing whether your internal control systems are effective, and if they are not, you correct them, you do a corrective action. So I think that is that. Then you have characteristics of a good ICS. So I think those ones, I don't want to belabor on things that you can read and get it. Unless, so I want, once you read, if you have a problem, then you ask. Because some of these things are very, very basic but they are very important to know. They may look, they are basic, I agree, but they are very, very important. So something else I'll want to touch on is importance of ICS over the accounting systems. So one of them is to ensure that transactions are executed in accordance with proper authority. So if you have an internal control system over your accounting system, one of the things that you'll have is that maybe you have two signatories in a check, things like that. You have only one person can cash a check to ensure that they are executed in accordance with proper authority. So who does what, things like that. Then to ensure that only valid transactions are recorded. So also in the book of records, who records accounting transactions? So you have maybe one person doing that. Then to ensure all transactions are promptly recorded at their correct amount, I think that one is clear. Then to ensure that the recorded assets are compared with the existing assets at reasonable intervals. And to ensure that errors and frauds are prevented, detected, and corrected. So remember those three things that an internal control system should do. It should detect, it should prevent, and correct. So those are the things an internal control system should do for you as an organization. Prevent, detect, and correct. So prevent, if it is unable to prevent, at least detect. If it detects, then it corrects. Then we have responsibility over the internal control systems. So we have some responsibility that lies on management, and the other responsibility lies on the external auditor. So the work of designing internal control systems and implementing them lies on management. It is upon management every day to come and remind people or employees that check inaandikangwa na huyu peke yake. That one is, as if I'm the manager and I have said that, I have implemented the internal control system and I have designed it. So naingia tunasema check, kutoka leo check itakuwa inaandikwa na accountant peke yake. Only that. Maybe the checkbook was lying around, I say itakuwa inaandikwa na huyu peke yake. I have designed an internal control system and I have already implemented it. Then it is the work of management to prevent and detect fraud. I'm supposed to check nione so and so is acting funny. I'm supposed to detect that fraud. Then I'm supposed to safeguard the company's assets. So keeping title deeds safe, keeping assets of the company safe. And then also as management, I'm supposed to prepare and present financial statements. So by the virtue of the accountant preparing the books of accounts, he's preparing on my behalf as the management. Then responsibility of the external auditor, one of the things that he's supposed to do is to understand the internal control. Auditor ukikuja kwangu, understand internal control systems. How do they work? Who does what? Things like that. Then record the system and evaluate it. We test system, test whether it works. That's what we talk about analytical review procedures. You test, does that system work? Then you record and identify the weaknesses in the system, and you will even provide recommendations for improvement, carry out risk assessment, and report to the shareholders and those charged with governance where weakness persists. Then you have areas where most organizations put control. This will be things like payroll. That's why you see the reason why we have so many ghost workers in government is because of poor internal control systems in terms of the payroll. Because you're supposed to have very proper internal control systems in the payroll, purchases and creditors, sales and debtors, stocks and work in progress, and so forth and so forth. Then, so there's some things that I don't want to go over, and it is ICS over everything. So check internal control systems over payroll, over what it's upon you to check. it's things that you can, I want you to read for yourself so that you even reason around it, and you will see that it actually makes sense. Let me use an example. So, for example, internal control systems over the payroll, some of the risks associated, okay, like this one, I've already mentioned it, unauthorized payment of dummy workers. So the ghost workers that I'm talking about. Then manipulation of the rate of pay. So unapata kwa, I don't know if you guys have heard, kwa mjengo, people are supposed to be paid 600, foreman anaamua, no, I will pay these guys 400, ndio nikule hii 200 ya juu. So that is because there are no proper internal control systems. Then payment for work not done. I'm supposed to do this and this, nalipwa the full amount when I have not done everything. So things like that. So these are things that you can actually read pole pole while you go over it. Let's talk about control over sales and debtors. I just want to show you how you should go about it. So if you're talking about control over sales and debtors, what are your objectives? So one of them is to ensure that customer orders are promptly executed. So if a customer makes an order right now, at I receive after how long? If you have proper internal control systems, you'll be able to detect that order and execute it almost immediately. Then ensure all credit sales are properly authorized. Ensure all sales invoices are recorded. Ensure all dues from the customers are received promptly. So those are things that you can think about and read. So yeah, I think that is that. I don't think there's anything else I needed to mention. Okay, actually there is. And it is on open page 94. Action taken by the auditor if the systems are weak. It's on page 94. Umefika hapo? So, action taken by the auditor if the systems are weak. So, if at all as the auditor I find that the internal controls are very poor, kuna ghost workers, order hata ya customer it takes like 4 days to be made, ama hata some customers have not even paid and the system has not detected. Mimi kama auditor, mimi nime-realize some orders have not been paid. There are some things I'm supposed to do. And one of them is you bring the weakness to the attention of management. Then you document the weakness in the management letter. You document the weakness also in the working papers. You change the auditing approach from a system-based to a vouching audit. So meaning that the risk has increased. So you're supposed to approach this audit as a very risky client. Then you increase the sample sizes. So if at all we were checking, analytical review procedures also involve taking samples. So if at all we were doing 5 samples, and then we realize that the internal control systems are not working, you increase the sample size. Then you change the timing of the audit and begin earlier, because you know if you're increasing the sample size, you will increase the time that you're taking. Then if the system are extremely weak, qualify the audit report. So kama unaona these audit reports, they are very weak, you qualify the report. Useme tu sasa, at this point, clearly these financial statements, they do not present a true and fair view. They cannot present a true and fair view given the weaknesses that I have identified in the internal control systems. Sawa sawa. Then also let me mention management letter. It is the thing that follows, and it is a letter that is written to the auditor, by the auditor, sorry. It is a letter that is written by the auditor to the company's management to highlight the weaknesses identified by the auditor and to provide recommendations for improvement and any other matters of concern that the auditor may wish to raise with the management. So the reason why I wanted to highlight that is so that you know that management letter is written by the auditor to management. So management letter by auditor to management mostly highlight weaknesses identified in the when doing the audit in the internal control systems and to make some recommendations. So kuna hizo purposes ni hizo tu zetu tumesema. So there are other points of course, but the thing to note is to report the problems or the weaknesses that you have identified in the internal control systems and to give recommendations on how they can improve it. Then you have contents. That one you can read. Yeah, that is basically what I needed to tell you guys. And yeah, so keep reading, check. I'll keep sending the questions in the group that I created. And yeah, so we'll still have our cut on Friday. So mkwe ready, mkwe ready. It will be basically the things we've been talking about. Have a good day.